So when you see covered call, what is covered call and all, we find several things. A lot of theory around to covered call, but the challenge is we don't know what are the adjustments in case underlying goes against to us. What to do? This is the main topic I want to cover today's session. Of course, in Smart Investor channel, there is a very big playlist under the name of covered call and adjustments. Whatever trade I take and what is the adjustment I took, I have recorded there and I published as a video. One can also learn from their videos what are the scenarios. I covered my covered call, what are the adjustments I made, how it went. All those things were recorded and uploaded into Smart Investor channel. You always go there and learn from that. So basically, this session is to make more interactive one another, to learn from things what I know and share it, and maybe what you know, you can also share it back. So without wasting much time, just I'll brief you on what is covered call. Then I'll get into covered call adjustments. Yeah. So let's say what is covered call? A simple basic term. If you search in the Google what is covered call, we'll find it from various websites. Let's say Investopedia, what it says. Let's open it. Yes, I'm not going to read out all those things because even you people also can read and understand. It appears like this. This payoff graph will be like this. What is all those things? This is the basic payoff chart, how it appears and all. If you see what is the covered call, in simple term, covered call is that we have an underlying asset and equivalent. Like, so I have a stock. Underlying asset means, let's say I have Reliance Industries. A lot size is 250. I have an underlying stocks, lot size 250. This is the one. But see, covered call, before getting to covered call, my view is there like basically my thought process is I am for long-term investor. I don't mean that today I buy stock and tomorrow I want to sell it out, or next month I want to sell it out. That is not my actual view. If that is the view, what we'll do, covered call is not a better way. It's simply maybe we can buy shares and leave it. If my intention is for 1 day or 1 week. Only this is considered only if we are a long-term investor. Then that is the way we consider this covered call. That is what it says. So if you see a covered call, popularly strategy used to generate income from the form of options premiums. Okay. So understanding the covered call. Let's see if you see this meaning of covered call. This is for a neutral strategy, right? So neutral underlying stock, neutral to up to some extent, not very bullish or not very bearish. This is a scenario I would initiate a covered call. Means Reliance, let's say I take Reliance, again, same example. I'll buy 250 stocks. What is 250? This is a Reliance lot size. Lot size is 250. But now, as of now, stock price is 2000, let's say 2630. This is current price. So my purchase price is 2630. I bought for 250 lot, right? 250 into 2630 would cost me 6,57,000. Let's say round figure 6.5 lakh. So this is my investment. So what is my expectation? Reliance Industries in shorter to or near to longer term, it would go to, let's say, 3,000. My view is 3,000. But we all know that Reliance Industries is the being Nifty or index heavyweight stock. Another 400 points move within a week or within a month. Hardly we see this one. So almost impossible. We cannot rule out, but generally we can say it's impossible scenario within a month go to hit 3000. Even it never hit all time 3000 also. So even Reliance Industries, if it stays here itself for another like a 2 months, maybe another 2 years, if it stays 2 months to let's say 2 years, then I don't get anything, right? Reliance is best known for very neutral stock. It hardly moves either side, but investor hardly get any income. So that is the case. What I do, this is my cost price. To earn out of this investment, let's say a normal example I can say, you bought a house, you purchased a house for let's say 50 lakh, right? 50 lakh invested in a house like a flat you bought. What do? You give it for rent, right? You give it for rent. From rent, you collect every month some income. Same principle in covered call. That's it. Simply you can here 50 lakh investment in a flat is equal to 6.5 lakh of stock, just like that. And the rent you collect every month is equal to you sell a call against this underlying security. Now you have a 2600. 2600 is your buy price, right? Now you go this month 2700, let's say 2700. CE, you sell CE. Maybe price would be around let's say 30 rupees or 25. That's okay, 30 rupees let's say. So by selling 30 rupees, how much do you get? By selling 250 into 30, you receive 7,500. This is what we call monthly income. So this 7,500 rupees you receive this month. By within this month or within these 3 weeks, Reliance Industries may go to 650. What are the scenarios? Let's understand the scenarios. Spot is 2630. So what are the scenarios? Scenario number 1. It stays here, say neutral, means my investment goes nowhere. Second scenario is it would go to 2650, slightly 20 points up. Scenario 3, let's say it would go to 2700. Scenario number 4, maybe 2750. Scenario number 5. Scenario number 5, let's say it can also go to 2500. Who knows? These are the various scenarios. So we'll understand what are these scenarios, what to do. Scenario 1, scenario 2, scenario 3, scenario 4, and scenario 5. What are the possible things we can do? These are called adjustments. That is what we are going to discuss this evening. So let's understand Investopedia, what does it say? Yeah, this is what we understand. This it looks like this is the payoff graph. This is we know that this is the underlying stock, and like this. This is the payoff. So one point of time, profit is arrested and locked. We do not get any other more profit on that. We'll see why. So what is the maximum profit and maximum loss from this asset? Maybe I don't cover all these things, not required. Yeah. So loss is limited losses, upside is limited, I mean, no loss upside. A loss is, what is the potential loss is downside. If it goes very much down, that is the loss. Covered call cannot help you to recover. Upside is, yeah, we don't have any loss from upside. Let's understand what are the pros and cons. This is important. So pros is that we know that, right? So we'll earn every month some income by selling the call. What are the cons? If stock goes beyond our strike, let's say we sold, right? We sold 2,700, right? Our intention is to hold it for long term, but stock went up maybe 702 or 750 as well. Means it went very higher than our strike price. Eventually, we'll have to give the underlying stock. Our intention was long term, but we have given this for very quickly. Of course, we got a profit, but our purpose was not fulfilled. And another thing is, it is very bullish. Let's say we hardly see, but Reliance Industries in a month itself shoots up 10%. If it 10% up means what? Like almost more than. If it is 10% up means it is 500 points up. If 500 points up in a month or even 2 months, what happens? You just only profit, you just only use cost price is 2,650, 630, right? This is 630, and from this you will get 70 rupees. You sold for 30 rupees, right? If you remember, we sold call for 30 rupees. So that price, together you receive only 100 rupees. This is the premium, the total profit at any cost, you will get 100 rupees, which means you will get 25k. Max profit is limited. You will receive only 25k. What happens here? Reliance rallied 500 points, out of which you collected only 100 rupees. So what is the other potential upside loss? 400 points. Which means 1 lakh you lost. Loss means, yeah, not a realized loss. You lost the opportunity of 1 lakh. Opportunity of 1 lakh, you lost it. Because call you sold is not able to help you do anything. Of course, there are several ways that we discuss. So this is the worst scenario for covered call. That's what it says. So if it is very bullish, covered call is not meant for that. It is of no use. Let's see. So that's where it says when to use, when to avoid covered call. Then covered call is should not use when it is very bullish. And again, covered call should not enter a trade when it is very bearish. So I say here, very bullish, you don't take this trade. Very bullish, very bearish, no trade. No trade. I say no trade means you don't buy underlying stocks, or which means no covered call at all. You say very bullish. It is very bullish. No covered call. I say no covered call. You have to wait for that, because you should not regret that, right? 500 points rally, you hardly collect 100 points, another 400 points, you lose that opportunity. So no covered call. So these are the scenarios. Don't work for covered call. All other scenarios, yes, we can manage. That is what we'll see in the today's adjustments. Let's move on to that. Okay. So what are the adjustments? I told you, right? Just we understand the scenarios again. I'll write it here. Let's say for easy sake, Reliance is 2,600 bought price. What is scenario 1? You sold call at 2,700. 2,700 is you sold 2,700. So price is 2,600. You sold at 2,700. Now, what is scenario? Let's say price can go to 650. Yeah, 2,650. Scenario number 2, 2,700. Scenario number 3, 2,750. Scenario number 4, 2,800. Scenario number 5, 2,500. Let us see what are the scenarios we can deal with. Right? Let's understand. So, scenario number 1, 2,650. After you sold the cover call, spot went to 2,600 to let's say 2,650 by end of July expiry. Right? End of this expiry, spot went to or close 2,650. Do you have any problem? No. So you are happy. So premium you collected, we discussed, right? Premium we collected 30 rupees. So what is your profit from the cover call? 250 into 30. So 7,500. This is your amount for this month. Now stock went up and closed at 2,650. Then what do you do? So its case is no adjustment. And also I'll tell you one more thing. Several cases. In case there is a possibility, no adjustment is also a best adjustment. I repeat, adjustment is not always good. Our intention is that this Reliance would not go beyond 2,700. So that is our view. When stock underlying goes against our view, that is where we turn into adjustments. Otherwise, if at all there any opportunity to not for any adjustment, please don't make any adjustments. So no adjustment itself is a great and better adjustment. So in this scenario number 1, spot went to 2,650. You get the profit of 7,500. You close the trade. Now you go to July. July is over. Now we go to August. You go to August month. Again, you sell 2,700. 2,700 call you sell. This time you will get it, let's say 50 rupees. Right? So you get 50 rupees and it premium you receive 12,500. Because spot is little closer and time value is very high. So you got another 5,000 more compared to last month. You are happy, you got a good premium. Then what happens? In August, let's say July is scenario 1 over. Now this is August. August month is scenario number 2. August scenario number 2. At the time of expiry, what happens? Reliance Industries closed at 2,700. So do you need any adjustment? No. Here also no adjustment. This stock has closed at 2,700. That is called ATM, right? At the money. Closed at the money. You don't need for any adjustment. just pocket the entire premium, forget. Now you enter into September. Let's go to September. What is September scenario? Now ATM is 2,700. Again, my strike price, for the simplicity, I'll leave it as, again, I'm selling 2,700 only. Remember, same strike. I'm selling covered call, always 2,700. So this time, what is the premium I would receive? This is ATM. Maybe you would receive 70 rupees, right? 70 rupees premium you are receiving in September, which is 17,500. Very good. So you receive very good premium, very much, very good. Now, let's understand. So spot is, this is the scenario, this is September scenario, right? This is September scenario. Spot is 2,750, which is scenario number 3. What do you do? So stock is closing at 2,750. Where are you? You are at, your premium received 70. Plus what is your break even point? I'll show you all of them in the payoff as well. Just let's understand the basic thing. So your break even is strike plus premium, right? So 2,770 is your break even, BEP, right? So stock ends 2,750. Here is no issue, but you premium receive hardly 20, because out of 70, spot has come 50 rupees. So 70 minus 50 is 20 rupees is final profit. Let's take October. Now again, you sold 2,700 strike. Maybe again, let's say due to some reasons up and down, again you sold it. Let's assume that you sold it 50 rupees. Spot went to 2,800. So you received premium 50 rupees and 2,800 is the spot. So your break even is 2,750, but spot is 2,800. So what is the loss? 50 rupees is loss. What do you do here? This is the things we need to understand. So one option is, if you don't want any adjustment, what do you do? Simply you give the underlying stock, what is called just a giveaway, right? Give the stock, give it and forget it. You take the profit. 2,850 or 2,750 is the total profit. Means you bought 600 and total premium after premium 750. So what was your premium received? 600 plus 750. Totally you got 150 rupees premium, which means total. So 150 rupees profit, 150 points profit you received. Total profit from the stock is 37,500. Adjustment number 2. These are the scenarios we have seen. What are the scenarios and what are the various adjustments? Generally, we can think about that. Again, see, throughout this session, I'm taking the Reliance as an example so that help us to understand simple. And Q&A, anything, just I'll take it at the end. We'll discuss any other scenarios, you have it. Now, so what is the adjustment from the Strangle? What is Strangle? Let's say Reliance call you sold at 2,700. 2,700 is the call. Spot is 2,600. Remember, spot is 2,600. But covered call you sold is 2,700. So if stock between 600 and 700, you don't have any problem. Whatever premium you sell or whatever premium you receive, that is your profit. Let's say I have a little bit risk to take. I'm ready to take a little bit risk, but not very much risk. And market condition is, I repeat, market condition is bullish. Bullish means not very bullish. Okay, let's say market condition is bullish, but not very bullish. So what I do, I sold already 2,700 call for, let's say, 50 rupees. Let's say 50 rupees premium I receive. You want to receive some more profit. You want to do something. What you can do, this is the one what you sold is a covered call. This one you sold. Then come down little bit, 1 or 2 strikes in terms of hundreds. Come down. Spot is 2,600. Then come down. Maybe not very 100 in terms of 100. Not very near to that. Let's say what are the 100 strikes? There are 20 rupees each. 20 there is strike. But I'd say this is a strike is, let's say, hundreds multiples. 2,500, 2,400 strikes below 2,300 strikes. Here in the bullish scenario, Reliance hardly can come down to 500 or 400 or 300. What do you think? So based on your view, you can take risk. Let's say you think in this month Reliance never goes to 2,400 at all because it has been very bullish trend. There is a news, demerger news and a strategic investment or Reliance Jio financial services, some blah blah news are there. Market condition is also bullish. There is no point why Reliance would be corrected to 2,400. Then go to 2,400, put sell. 2,400 sell. This is called Strangle. Maybe you receive 20 rupees, maybe 10 or 15 rupees, whatever premium you have by the time you receive. So in addition to 50 rupees, you also receive another 20 rupees with this almost similar margin. Maybe hardly you pay 10-15,000 extra. So what is the additional premium? Total premium you receive 70 rupees, which means your total properties would be 17,500. This is a strangle. By this strangle, you can increase your monthly income. This is the adjustment number 2. Adjustment number 3, straddle. By talking about the straddle, I can say first point is this is very risky. What is a straddle? Let's say you sold 2,700. Spot is 2,600. Again, I repeat, 2,600 is a repeat spot. 2,600 to it went to 2,700. This is where you want to make some adjustment. What is the possible adjustment you have? You have adjustment for straddle. What is that? Same strike you sell put and you sell call. Means 2,700 put also you sell 2,700. So you have straddle 2,700 call and 2,700 put. Both you sold. So we know the market would not stay there, right? There are all possible scenarios that Reliance would go and close above 2,700 and also close below 2,700 also. Maybe 2,600, it can come down also. That is where you'll be in trouble again. So that is why straddle is risky. If you are good at adjustments and all, you know what to do. If it goes down, then you can make this straddle. Otherwise, I can say avoid this straddle adjustment. Now this is now bull call. What is bull call? I will tell you. We all know, right? What is bull call? Is just I will tell you. Let's say 2600 is again spot, and it is coming to 2700, which is your sold strike. You would think that the Reliance Industries would go even further, which is the risk for you. If it goes even further, if it is any very much bullish more than this, that is where you are in trouble. Means trouble in the sense you might need to give the stop. What you do? You need to increase upper break even. That is where you initiate bull call. Means this is a 2700 is a call, right? Minus one strike. Minus one strike. Go minus one strike. What is minus one strike? Means this is 2680 call and 2700 is it your sold call, right? This is buy. This is again sell. This is called bull call, right? Buy lower strike, sell upper strike is called bull call. But this bull call is our strategy is no, after this bull call we have calls and 1 by 2680. What will happen? This will give you upper break even point. Let's say 50 rupees premium you receive by selling 750. 750 is your premium. After selling, after this adjustment, you will get 20 rupees more. Your break even is 2770 is your break even. This is the adjustment number 4. 2700. I'll erase. Let me erase this one. Scenario is the same. Scenario is the same. Market Reliance came to 2700. Then 2700 put. 2700 put. Here also put. You sell. And below one strike below means what is called 2680 buy, right? So what is the bull put? Sell upper strike, buy the lower strike. This is called bull put. Again, this will also give you another 20 points for break even to give you upper. So it's up to you based on your liquidity and strikes available. You can take either a bull call or bull put, or you can do another option is again maybe this is 2700, right? You can go one strike up means 2720 sell and 2700 put buy. So this is sell, this is buy. You can do like this also. Whichever gives you higher break even, you can take it. That is adjustment number 5. What is the other adjustment? That is no adjustment. Simple. I mean, just let's say a spot, Reliance spot is 2750. You already received 50 rupees premium. So what do you do? Simply roll over. Simply roll over to next series. This is one scenario. What is another rollover scenario? Let's say Reliance Industries went to 2800. Premium you received 50 rupees. 2800 is the higher one. So you already lost of 50 rupees. So what you do next series? What is the loss in this month? You book loss of 50 points. You book loss for 50 points. But next series, if you sell 2800 call itself, next series you sell 2,800 call itself, you would receive 70 rupees. Understand this one? I can repeat. This spot went higher than your sold strike and is giving you 50 points loss. You are lost at 50 points. You close the trade, I mean covered call, not trade, covered call. Go to next series. Sell 2,800, which is ATM. 2,800 ATM at premium of 70 rupees. So earlier you booked loss of 50, but here you received 70 rupees. Now what is the current month balance? So loss is 70 and you received premium, loss is 50, received premium is 70. Net to net, you are in 20 rupees profit. This 20 points profit per 2 months means per month is 10 rupees. Per month, you can say 10 rupees, means 10 points per month. This is where you will get very less premium you can think about, but your intention is to hold the stock for longer period, right? This is where you can do rollover. What you can do? So you can do like this. This is rollover number 2. Now, so what is the other thing? This is rollover number 3. Now, Reliance Industries went up to 2,900. Obviously, you are in loss, right? This 750, your 750 is the no loss zone. But Reliance Industries went up to 2,900, which is 150 loss, right? This is 150 loss is 1. So how do you roll over here? You received premium is 50 rupees. Premium received is 50. Loss is 150. So you want to give away you want to close the entire trade, or you want to continue to be in the Reliance Industries being a good stock and you expect even more upside? What do you do? Yes, in this case also you can do certain things. You book loss of 150 rupees, which means say means 150 loss in the sense what is that? 150 into 250, 37,500 loss you are booking this month. But you would think that Reliance Industries is not even 2,900, it would go to 3,000. This is your expectation. It would go to 3,000 even more. So what would you do? Next series, you already booked loss of 150 rupees, right? You already booked loss of 150 rupees. Then in the money call, remember, in the money call, ITM, in the money call, 2,800 call you short. This is the in the money call. I mean, you already booked loss of 150, but Reliance spot is 2,900. In the money call, what would be the premium? Already 100 points is another maybe 70 points, right? It's 100 plus 70. What is the total premium you would receive? 170. You receive 170. Loss is 150. Premium you receive 170. So totally again you are into plus 20 rupees. If stock stays there or stock comes down to 2,800, still you are in good profit. Stocks they say, or even it goes to 3,000. You already received 170, right? Break even is 2,970, almost net to net break even. Here you can take decision. Still you want to continue to roll over, or you want to book the profit, because your intention is Reliance, you want to sell at 3,000. The target you already received it. So that's enough. You got everything. Reliance reached to 3,000. From here, you think that it would not go anymore. Maybe it would take correction. So this is the time you can still book it, or again, I told you options, right? And the rollovers, you can continue. This is the adjustment number 6. These are the adjustments on paper. So far, is it clear? Then I will show you over the sensible. Before take you to the sensible, are you all clear? All the 6 adjustments? Any queries? Maybe quickly unmute yourself and let me know. Then we'll go to, I will take you through sensible. So far, hope this is clear, right? Now, just I will show you one example. Any adjustment you want to see on sensible? Just I will show you that. Any adjustment you feel a bit.
One more scenario, right? I mean, if stock went to 2,500 from 2,600, that scenario I think we missed, right? Yeah, of course, that is opportunity to invest more. But do you have any other adjustment in this case?
Okay, good. So let's say 2,600 is a spot. Maybe what if happens 2,500? It is not much bearish scenario, right? This is just a smaller dip. So you bought at 2,600. This is a bought price. Already trading. Maybe you'd be getting 25k loss. So what would you do? Still, in this case, still you can sell 2,600 call, right? Maybe you don't get much premium, but you would get a call of 20 rupees or 30 rupees premium, which means you receive premium of 5 rupees. 5,000 or 6,000 still you can receive. You continue to do that till stock comes to 2,600. That is the one scenario. This is a good scenario. Let's say maybe not 2,500. Let's say stock went to 2,400. 2,400, it has been there for maybe several months. I can say several months it stayed there. From 3, 4, 5 months. Your portfolio showing 50,000 loss, but 2,600 strike is hardly any premium. You start worrying about this one. What would you do? So generally, one option is if the stock is continuously going down, right? You cannot do no cover call. Don't go chase the stock. No cover call. What happens if you for the premium you have to go down, right? So let's say you have to go down 2,500, or you need to go down 2,400. Let's say you initiated 2,500. Just for premium of 25 rupees, again you initiated 2,500. But bought price is 2,600. Your bought price is 2,600, but you sold strike is 2,500. We never know that. All of a sudden, 2,400, again stock came to 2,600. What will happen? You will be lost in call, you will be lost in underlying. So both from the investment point of view and the call point of view, you will be in loss. So if you want to think it doesn't want to happen to you. In this is the case, don't no cover call for few months. And point number 2, still continue to this 2,600. You will get some sort of premium. Continue to do this one. Don't worry, but yeah, times are like that. Sometimes are like that. We know Reliance Industries has been there 2,600 for several months. Very recently, it has moved 2,500 and 600 recently. So in that case, still you can sell 2,600. This is a one option. Then I'll tell you a fourth option. What is fourth option? Still you can sell 2,400 call with a stop loss in mind. Let's say Reliance 2,400 onwards, it is still going to 2,300. Market condition is very bearish. You don't know when it does get recover. Conditions are not favorable. You can sell 2,400 with a double stop loss. Let's say you sold a premium of 30. Double stop loss is 60. If 30 becomes 60, you exit, or if not, you continue to sell with 30 rupees premium until it gets recovered. If it's getting recovered, you apply again normal conditions, say rollover condition or bull call condition, bull put condition. Adjustments are there, right? Several adjustments. Accordingly, you can apply same, but with a predefined stop losses. You have to consider all the stop losses in place, then you can take some risk. If you are not good at the stop losses, you don't know how it happens, then you can leave. This is one adjustment. Then what is the other scenario? If you don't want stop loss scenario, what is the other scenario you have? 2,400, right? No. What is the other thing? You can do that bear call option. What is the bear call? I can say here, bear call. I didn't cover there in the adjustment. You can say bear call. What is bear call? You sell 2,400 call. This is a predefined stop loss. We don't know, right? Suddenly gap up with 100 points. There no stop loss would work there, right? So that is the way you take a strategy with the stop loss built in. So inbuilt stop loss, you take them. What is called bear call? Means you sell 2,400 and above this strike, 2,000 maybe 440 call buy. So this is sell, this is buy. So what happens? As long as stock continues to there in 2,400 below, you will get the profit of what is the difference. In case it gaps up on 100 points, no worries. Still you get, this is a bear call. You will get a risk defined strategy, right? Bear call is a risk defined strategy. You will get some profit, right? By the strategy, you will get some loss, or probably some loss. Book the loss. Second time onwards, now continue to do your cover call strategy. You go up because now Reliance came up to 2,500. There is a loss. A defined loss is there. Book the loss. Now spot came to 2,500. Then you go up to 2,600 and continue to do your cover call as we discussed earlier. This is the scenarios, bear scenarios you can consider. Yes. Any other questions?
Yeah, thanks, Ganesh, for the information. It helps.
Maybe I will show you one scenario insensible. Let's say Reliance Industries spot is 2,633. Let's say you sold a call, 2,500 call. You sold, 2,400 call. You sold. So this what call you sold is 100 rupees. Let's say 100 rupees premium you got. What will happen? So what is break-even point? Break-even point is 2,000 ESC. Break-even is 2,600. 2,600 is your break-even. But it's already cross or break-even. What is the adjustment you can do here? As we discussed, anybody, any guess? Any adjustment here? What is the right adjustment to consider at this scenario? 2,500 call you sold at 100 rupees and the spot reached to 2,633. It went up beyond our break-even. What is the adjustment?
You can
bull
call. You can sell additional one. Make it
very good. Yes, bull call. Let's see bull call. As per our discussion, bull call is break even is 2,600. Below one strike, let us say one strike is 580. Buy this one. This is sell. So what is the premium? Additionally, I am getting only 7 points here, which is not much looking attractive. Yes, because it is already crossed our BEP. Just when it comes to our BEP and it comes to close to our sold strike, that is where we need to quickly react. Otherwise, our adjustment will not be much effective. So more you delay, your adjustment is not much effective. You have to take action as soon as possible and it comes to your break even. Right? So this is a scenario that actually I not covered here in this scenario. I can say, let me put it here, another adjustment number 7. This is called call butterfly. Remember, this 7th adjustment is call butterfly. What is butterfly? I will show you directly in Sensible itself. Now, so this adjustment is not giving much break even. So what do you do? Remove this. Yeah. So what is call butterfly? So slightly in the money buy one. What is buy 2,600? Slightly in the money. Buy this one. No, this is the money. Let's remove that. Okay. Buy this 620. Go one strike up. 620 buy and 660 sell. How much the difference strike? 20 and 60. 40 points. The year sells 2 lots and go to 70 buy. This is one. Do you understand? I'll show you here. I'll show you this is just a switched off my cover call. Let's see what I have done here. Understand? Okay, this is important. Hardly people know this call butterfly for cover call, but still you can use it very well with minimum cost. What is the cost? For this we are using only 1,000 rupees. That's it. With 1,000 rupees, the chances that you get additional profit is 8,800. You're losing just 1,000. If at all you would get 8,000. Means almost 9,000. But yeah, probability is very less. That is okay. Now this probability point of view we'll see later. And you'll see break even 2,624 is lower break even. Upper break even is 2,695. Very good, right? This is very good premium and very good break even you are getting upside. Earlier we already crossed the break even. Now with this we are getting good break even. If we add this call butterfly, this is called call butterfly, CBF. You can call CBF, right? With this call butterfly, you see if I keep it on this call, what is the break even? See here. Here you don't see break even. It doesn't appear as a green. Don't worry. This is the technique. It doesn't appear as the break even as it was before. But understand this. Let me switch off this butterfly. If I don't have butterfly, what is the loss at expiry? See that at expiry loss is 8,000. All of you just focus on this. Reliance expired here itself, and the expiry loss is 8,000. If you enable butterfly, imagine if you enable butterfly, this is one, right? What is the loss on expiry? Just 6,000. You are recovering 2,000. You're recovering more than 10 points or sometimes 15 points. But not only here, even if it goes to 2,656, I'll tell you 2,000. Let's say 660. This is sold strike, right? 660 or 2,700. I'll show you. I'll show you another future testing, not back testing, future testing. One scenario is that 2,660. Let us see 2,660. 2,660. 2,660. What is the loss? 16,000. See, what is the loss at expiry? 15,000 loss. If you don't make any adjustment, you don't add butterfly, call butterfly. Let's say you are not added call butterfly. Loss at this spot is an expiry 15,000. If we enable call butterfly, at the same at this strike, What is the loss? 6,000. Guys, understand this one, or I'm going to repeat. If you don't add call butterfly adjustment, loss is 15,000. If we add call butterfly, Reliance expired at 2,660. Loss, max loss, we are getting 6,000. So 11,000 loss. 9,000 loss you recovered. Do you understand this one? Now, say let's say 2,700. What if it goes to 2,700? 2,700. What is the loss? Again, 26,000 loss at expiry. Enable again butterfly. The same butterfly, let's say, after enabling them, 2,700, right? 2,700. What is the loss? 26,000. No advantage. So 2,700, no advantage. But anything below 2,700 means the strike. This, what is the upper strike we bought, right? If Reliance closed within this range, you would get within this range, right? It is within this range. It expires, you would get good, minimum loss. Best case is 2,660. If it expires at 2,660, you would get very minimal loss. Then what you do next? With this minimum loss, you can do rollover scenario, right? You understand, right? You remember rollover? With the rollover scenario, you'll get a next cycle, you get a very good premium with a good rollover cost. Then you continue to do best covered call again, as we discussed before. This is the covered butterfly is the one you can add Reliance Industries or covered call to reduce the loss, not to make you profit, but reduce the loss. That is the other scenario. I think that's all from my side. If you have any other queries and anything, please let me know. We'll address the query or we can close.
One strategy in Sensible, they shows Batman. What's your views in that? Because it is coming with a higher range, like break-even range is very high. Some of the cases it gives 5% in lower side and 5% in upper side.
Okay. So, sorry. See, it is giving a higher break-even or a higher profit. There would also be higher risk. So you are increasing your risk. Means that manage you're increasing your risk. You're adding, pumping up more funds to that. That is where it shows that. In case something goes wrong, then your loss would be very high. So cover call adjustments, generally our intention is that if it goes wrong, we should not be in a deep loss. We'll get out with a good profit or minimum profit or with a good rollover cost. That is our intention for covered call. If you go batsman or other strategies, that depends on person to person. But if you continue to do such things, you are also increasing your risk. So more is the risk and more maybe you will end up with getting again higher losses. That is the risk. You need to consider the risk and reward. Based on risk and reward only, we go this covered call. Okay?
Thanks.
Yeah. So that is a pure trading purpose. So batsman, all of these things, these are even that works much better for index. The index is meant for range bound or certain range, right? But stocks, if continue to trending up, it can go at 10%, 20%. We don't know. That is the case. We'll be in the trouble. So, say as a being invest.
It seems to be similar to calendar type.
So then you can tell me, maybe we can here, what do you want me to add? If you want me to add, I can add here strikes and we'll see how it appears, then maybe we'll understand better. Do you want to suggest some strikes here for batsman?
Yeah. Suppose if Ambuja Cement, now I sold put at 490. So sorry, 400 PE.
You are talking about put covered call, or this is we are discussing about covered call, right?
Yeah, this is basically you can say this put selling only. Put selling is not a covered one; it is naked only. So like Ambuja is going down. Presently the spot has gone down. I think near to 400. It is coming near.
470. 470 is
Yeah,
spot.
470. So I sold 400 P in this Ambuja. So that is in the downtrend.
So you sold 400 to the 400 is the put, is it?
Yes.
Yeah, sold 400 put. Okay. This is called a naked put or
Naked. It is naked only. It is naked only.
Okay. This is a pure trading purpose, right? Not. This is neither.
Yes.
Covered, this is neither covered.
Yeah.
Cash secured put or not risk defined strategy. This is it has its own different side backs.
No, basically, I wanted to clear my doubt in when we are selling the put.
Okay.
So there is very much clarity. Suppose one is the scenario when our price comes, we are ready to take the delivery. And sometimes what happens, we do a cover call, like we have some cash stocks and we do the call sell. So when it is OTM, so we get the premium. So usually a covered call, in what scenario you say it's a covered call? I don't understand. Basically, cover call, put call, basically.
No, I think
how it can be covered.
No. You are talking about covered put. You are talking about.
Yes, covered put.
Covered put only you can do futures with cash only we cannot do.
Got it. So we are doing only naked one.
Yeah.
For the premium purpose, suppose if any targeted stock it comes in our range, then we are ready to take a delivery. Otherwise, only for the premium.
Yes.
So suppose when this Ambuja cement, it is the put is sold at 400 target price, and that is getting down.
Okay.
So when I was looking at the Batman strategy, so it is giving a range. Suppose they are insensible only. They are putting a focus on to sell the call at around 450 and 2 calls, and this put it is giving in the range of 380 and upper range.
Exactly. That's my appears like this, right?
Yes. Yeah.
This is one, right? So, see, this is the open. So this is
open.
This is unlimited loss. So this is what I'm telling. So with the covered call scenario is like upside and neutral or little downside as no losses. But when it comes to batsman, yes, range appears very good. But in terms of Ambuja, right? No, today 3.2% during this one. So tomorrow again another 3% or 5%. This being with the Adani group stock, it has its own disadvantage. Even 10% down. So this loss would be very high. Downside loss very high because this under the stock, downside losses are very high. Trending like anything, we don't even know. So batsman range is good. Only if you stick to heavyweight stocks, let's say Reliance Industries or maybe HDFC Bank, certain heavyweight stocks, maybe batsman may work. But generally, what initially I told, right? Batsman and all, generally we would not use for stocks. We would use for index options. Because index options do not tend to move 10%, 20% overnight or even in a week. But stocks still can 10. So that is where we are getting into risky. In the payoff chart or for the showcase purpose, it is very attractive, but real time, it will be in trouble.
Okay. Got it.
I personally don't suggest batsman kind of adjustment for the cover call or any other thing for stocks. Of course, you are good at the other view, or when it falls more, I can take more stocks and all. That is a scenario that is different, okay? But generally, don't go this adjustment for either a call side or put side.
Okay.
Thank you for joining. We are closing the session. Maybe next week we'll come up with another new topic. Meanwhile, just request that please do subscribe, and if you have any queries and think you can join. If you are there not in the Telegram group, you can join. We'll discuss several other things and any other queries. And please share, subscribe to our YouTube channel to help us to grow much better. Thank you very much for joining us.